Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hi everyone, my name is Heung, Senior Investment Strategist with Standard Chartered Bank, CIO Office, and very warm welcome to this episode of Through the Noise. And this week I have my colleague Rajat Bhattacharya, Senior Investment Strategist of our CIO Office, joining me. Welcome Rajat. Time flies and we have almost got to the end of the first half and feel really like we have passed ages. Maybe it's time to have a review, and so let's say, what are the main takeaway from the first half?
Sure, Ray. I'm glad to be here. So, as you mentioned, the first 6 months of this year, I think probably go down in history as the period when the world's economic tectonic plates shifted, setting the stage for a balanced global order. The US scaled back its leadership position during the first half and forcing Europe and China to shoulder more responsibility of driving global growth. Now, there are three main takeaways for investors, I think. The first one is the Trump put, the so called Trump put, is alive. Hence, avoid event driven panic sales on any major negative events coming through and focus on the hard data and investor positioning. The second takeaway is that China has found the US's vulnerability, which is the rare earths, and thus there are chances of an all-out trade war have faded. And finally, Germany's are finally reflating. Now, the last two takeaways send a salient message to investors: avoid over concentration in US assets.
Thanks, Rajat. I think that's very interesting. Maybe I just follow up with the first thing. What gives you the conviction about the Trump put?
Yeah, sure. So the significant scaling back of Trump's tariffs gave us the first sign. So he scaled back significantly his tariffs after US stocks, bonds, and the dollar all tanked following the initial imposition of the heightened tariffs in April. Now, this confirmed one of our core theses for the year, that market discipline remains an important constraint on the Trump administration's policies. Meanwhile, US Treasury Secretary Scott Bessent wants to re-incentivize US commercial banks to hold US government bonds. The Treasury has also recently stepped up government bond buybacks, and Bessent has said that he would be ready to do more. These measures should put a cap on bond yields, a key concern for investors. Now, given these policy backstops, investors need to avoid panicking during any event-driven volatility caused by unpredictable US policy. They should instead focus on economic and earnings data and investor positioning. Now, the past week's data has shown that the US job market, while slowing, remains healthy and disinflation is continuing its downtrend. So, inflation is continuing its downtrend despite, or shall I say, because of tariffs. This raises the chance of Fed rate cuts in the second half. However, with investor positioning remaining uncrowded, we see scope for further upside in equities.
Thanks, Rajat. That's very useful. Maybe you can also tell us a little bit more about the China advantage in trade negotiation with the US.
Yes, so China, as we found out, has found a core US vulnerability, which is the rare earths, and this reduces an all out trade war risk. And if you recall, I mean, we've talked about it before, but China produces 60% and processes almost 90% of the world's supply of rare earths, which are critical minerals used in the defense fighter aircraft, electric cars, robotics, and other high end electronics. Now, in April, it restricted the exports of several rare earths and magnets in retaliation against US tariffs. This actually eventually forced the US back to the negotiating table, resulting in this week's preliminary agreement in London. China agreed to accelerate rare earth exports after this agreement in exchange for the US easing controls on chip exports and reissuing visas for students. Now, this reduces the near-term chance of an all-out trade war, in my opinion.
I see. I see. So the third implication, sorry, the third takeaway that you mentioned is about Germany. Can you also give us, what gives you the conviction about a Germany recovery?
Yeah, the final lesson is about Trump, forcing Germany, Europe's largest economy, to shoulder more of the defense responsibilities and the responsibility for driving European growth. Now, the new Merz-led coalition in Germany has boosted infrastructure and defense spending plans. If they are properly implemented, and we do believe they are picking up, they should be implemented in the coming years. They could potentially lift German growth by 2 percentage points annually over the next decade. Now, with China also fiscally easing, and the wide gap in fiscal policy support between the US and the rest of the world, which was arguably the primary driver for the so called US exceptionalism in recent years, is likely to narrow in the coming years. Now, investors are starting to factor in this potential. If you look at the charts, well, you will see that the narrowing of earnings estimates gap between the US and Euro area in 2026 compared with this year, which suggests that there is this narrowing of the exceptionalism, so called exceptionalism, between US and the rest of the world.
I see. I guess the logical question to ask then is the what are the implication or what is the implication for investors of among those takeaways?
Yeah, in short, the investor should avoid over concentration in US assets. Now, the US is undoubtedly remains the global leader in delivering stellar returns for investors, thanks to its inherent competitiveness, driven by innovation and productivity, and its unmatched consumer power. But its outsized gap, as I mentioned earlier, with the rest of the world will likely narrow. As the gap narrows, funds that had left Europe and other parts of the world for the US over the past decade, following this US exceptionalism story, are likely to continue to return back home. This points to further decline in the US dollar. This also reinforces our final message: avoid over concentration in US assets and diversify, diversify, diversify. Those are the key things we keep reminding investors.
Okay, thank you. We touch on about Germany. I guess we can actually take it a little bit more macro. Talk about the European equities, maybe, especially with the ECB approaching the end of the rate cutting cycle. So, can we have a little bit more deep dive into that?
Sure. So the ECB cut rates by quarter basis points this week, and it is now brought the rate to 2%, which is half of what it used to be when it started the rate cutting cycle in 2024. Now, the markets expect another 25 basis point of rate cut by Q1 of 2026, as the ECB is forecasting lower inflation. And second, US tariffs pose a headwind to growth. Now, rate cuts, together with expected fiscal spending boost for infrastructure and defense in Germany and possibly elsewhere, support euro area equities. Now, the euro area equities have performed well this year, and they have outperformed the rest of the world, as we know. But the 12-month forward PE valuation of 14.5 times remains a significant discount to global equities. It's almost running at a 21% discount currently from versus global equities, versus average discount of 13%. Now, that means that we maintain a core allocation to euro area equities. There has been downward revision to consensus earnings growth for 2025 in the euro area since the start of the year, but we also noticed that for 2026, growth estimates, I should say, has been nudged higher. The stronger euro this year, which is up almost 11% year to date versus the dollar, hurts euro earnings, which derive almost 60% of revenue from overseas. However, fiscal stimulus supports the region's 2026 growth outlook. Within Europe, we are bullish on the banking sector given attractive valuation and shareholder payouts, as well as the industrial sector, which is likely to be a key beneficiary of the fiscal spending tailwinds.
Thank you, Rajat. I think we just have to ask one fairly current question, which is the surge in oil prices. And we saw escalation and tension in the Middle East. So, what do you think is the implication to us?
Yes, so reports, as you mentioned, suggest that Israel launched military strikes across Iran, targeting key nuclear and military facilities. Now, public statements from Israel's Prime Minister suggest strikes could continue while concerns are growing about the nature of an Iranian retaliation. We have seen already Iran retaliate with a few drone strikes. Now, in financial markets, the initial reaction was characterized by a jump in oil prices and a fall in equity futures. Now, Brent oil prices have jumped more than 10% before paring back towards a prior resistance of around $75 per barrel. The pricing in of increased oil supply disruption risks suggests there is room for surge in Brent oil prices, and this could extend further towards the January high of $82 per barrel in the very short term if there is further escalation. Now, while much depends on how the situation evolves, we would focus on three factors in the coming days. The first is the nature of the Iranian retaliation, as I mentioned, particularly any attempts to disrupt energy supplies. Second, whether oil prices hold below key technical resistance levels. I mentioned $82 per barrel for the Brent price. And finally, any impact on US inflation expectations as a result of higher oil prices. Having said that, we would balance near-term oil market worries against the longer-term context of significant oversupply relative to global demand and significant OPEC spare capacity. In all this, the yen and gold are also likely to benefit in the near term from any conflagration in the Middle East.
Thank you, Rajat, for the comprehensive sharing. We indeed have covered a lot of ground today. And that's all the time we have for this episode. Thank you for listening, and please stay tuned for our next episode of Through the Noise. Bye now.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.